Does it say recorded? Okay. All right, so we continue. This is now lecture number 3. Everybody, class is begin, okay? Lecture number 3 in accounting, okay? This is now the most important lecture for you to understand. Hello, well, yeah, you too. The class begin. This is now, for the two of you, the most important class for you to understand the called basic accounting equations so that you can do proper accounting in the future, okay? This is the most basic one, and you have to be very careful to understand the example which is coming today. It's going to be in lecture number 4, because that's the foundation of how you do accounting. If you don't understand today, you are in trouble, okay, in accounting. You will not understand anything from the rest of the class. So you need to be absolutely sure that you understand now lecture 3 and lecture 4, which is all of today. So we begin the basic accounting equation with assets, which equal liabilities, and known as equity. And I will repeat and explain again what assets mean. Assets are resources which a business owns. And resource is something of value which you can use to generate business or to generate revenue. In other words, something you use to make money, okay? I gave you as an example, the camera is an asset, the projector is an asset, this whiteboard is an asset, okay? The computer is an asset. So all of these things are used to generate revenue. Second, it provides future services or benefits. For example, the computer provides a service not only today, but also a future service. You got a lamp up here, provides service now, but it provides a future service. The projector provides a service now, but it provides a future service, okay? A computer provides service now, but it also provides a future service. So, it's a resource. You use it to generate business. It is providing future services and benefits. And examples include cash, supplies, equipment. I also give you examples of furniture. Furniture is chairs, tables, things like that. Equipment will be what we think: mobiles, cameras, projectors, monitors, computers, keyboard, mouses, okay? And the rest will be like real estate, like the building over here, okay? So we got a special one called buildings, okay? So this building is a big asset, okay? And the key to the building is whether you can attach it or you cannot attach it. Example will be air conditioner. Air conditioner will count as part of the building because it's not easy to detach, okay? Same thing with the door. Yeah, you can take the door out, but it's part of the building, okay? The chair, not part of the building. You can easily move around from one room to another or take it out of the building, okay? Same thing with the equipment. Okay, so these are the assets. Now we explain the liabilities. So, liabilities are claims against an asset. The way to think about liability is an obligation. An obligation. Another way to think, there are many ways to think about liabilities, is that liabilities are or represent creditors. This is the party to whom money is owed. One example of a creditor will be employee. Employee works in the company, and at the end of the month, the business, meaning, for example, the university or the hotel, owes money to employees. So while employees work in the hotel, until they get paid, they are also creditors. Another type of creditor will be supplier. Supplier is a special type of creditor. Okay? Example will be the electricity which the electric company provides the university. Okay? The university will pay the electric bill at the end of the month. Okay? But in the meantime, the electric company is a supplier of electricity to the university, okay? We, workers, employees, are suppliers of labor on credit until the end of the month when the university pays us, okay? And you also have accounts payable. Accounts payable is when someone, and you have to remember this, someone sells you something on credit and you promise to pay later, okay? For example, a supplier of fruits, okay, has a contract, I don't know, I'm just making up, with 7-Eleven. Every week we come and give you some supply, I don't know, fruit, okay? And when they bring in 10 kilograms of fruit to 7-Eleven, 7-Eleven doesn't pay cash immediately now, all right? They don't just deliver the fruit and 7-Eleven pay 1 minute later. It doesn't work like that. 7-Eleven will pay at the end of the month, okay? So in the meantime, they say today, 10 kilograms of fruit, I don't know, $2,000. Tomorrow, 20 kilograms of fruit, $4,000. So you add this all up, and it becomes account payable. At the end of the month, you make payment, okay? So this is all about money which the business owes. It may owe to suppliers, it may owe to the electric company, it may owe later on taxes to the government, okay? It may owe salaries to the employees, and maybe it will owe dividends to the owners. We call these the investors, okay? We also call them capitalists. So, liabilities tell you everything which is owed to creditors. And here is one last piece, is the owner's equity. Let's explain this part. Owner's equity means ownership claim on total asset. To be owner means effectively to make any profit you keep for yourself, and if there is any loss, you take the loss yourself. So the owner takes all the business risk, or the major business risk. So ownership is associated with high risk. If there's a profit, the profit is for me. If there is a loss, I have to pay it out of my own pocket. Okay. The owner's equity is, as I explained last time, the same as what we call the investor's equity. It is represented by shares, or it is represented by stock, or it is represented by what we called before partnership shares, or partnership ownership, okay? Or sometimes, if it's one person, proprietorship, okay? So, refers to residual equity. Now, let's explain this word residual. The word residual means anything which is left after everyone else is satisfied. So, owner's equity means all assets minus all liabilities. So, you have all the assets. Let's say all the assets is 1 million. You pay workers, you pay the electric company, you pay the you pay the government, you pay somebody else, you pay suppliers, and whatever is left out of assets is called a residual equity or residual claim. So the owner can claim only after everybody else gets paid. We call these creditors, okay? So after all creditors get paid first, the owner gets paid last. Whatever is left. If there is money left, he gets paid. If there is no money, he doesn't get paid, okay? And of course, the payment we call dividends, okay? Now, profit I will be explaining in the next lecture when a business makes a profit of 1 million. He can take all the profit and spend it, or he can take half the profit as a dividend and reinvest the other half in the business, okay? So, when a business makes a profit, two things happen. Part of it goes to the owner, which he spends as cash, and the other part goes in the business, as in, we call it reinvestment. So that's the owner's equity. And the owner's equity we like to call capital. So this owner's equity is confusing because it's got 3 or 4 different names. One, it's called equity. The other one is called owner's equity. Another name is called capital, okay? And another one is called owner's capital. So, we just learned to use the words equity or capital, okay? We can use owners and not use owner. Owner can be proprietor, can be shareholder, can be stockholder. Okay, let's see what else we have. Aha! This is a chart that you have to be careful to understand. When an owner makes an investment, it increases owner's equity. So, owner's equity goes up when the owners makes an investment. So, investment means owner takes money out of his pocket, 10,000, and puts it in the business. The business equity goes by 10,000. So, business equity increases when the owners invest money out of their pocket into the business. And owner's equity increases, and here's the other key. Revenue. Revenue is, let me repeat from last time, money received from customers for a good or service which is delivered to the customer. Okay? So, owner's equity goes up when the customer gets a service or a product. Okay? The owner's equity goes up. And then owner's equity goes down, we say decreases, when the owner withdraws. To withdraw means to take money out of the business and into his pocket. So withdrawal is the opposite of investment. Now, the correct term for withdrawal is dividend. Dividend is the proper, correct word, okay? Or withdrawal. So withdrawal is reduction of capital. When I say equity, same as capital. Reduction of capital because the business, we say the word distributes. Distributes, now we use the word capital. Distributes capital to the owner. Usually, in the form of cash, okay? The owner doesn't want to take a chair home, right? The owner wants to take cash home. So the distribution, the withdrawal, most commonly is in the form of cash, okay? In the form of cash. He will rarely take, for example, a computer. He may have a small business, a little hotel. The hotel has 5 computers. He's not using one of the computers. He can withdraw a computer and take it home so his child can play games, okay? Or his son is going to school and needs computer to study these days. So this is how equity is affected by investment, withdrawal, revenue, and now we get to expenses. Expense is a resource which you have to sacrifice or give in order to keep the business going. The expense, most common expense is employees in the form of salary and wages, okay? This is the money which is paid to the employees. Another common expense, I just gave an example, is electricity. You have to pay the electric company. Today, most businesses have a very common expense of phone. Businesses use telephones. They pay money for the telephone. Okay? So, this is the money that you pay to keep the business going. Okay? There's got to be some cleaning. That's an expense. The cleaning supply, the soap, that's an expense. Here is another example of an expense. This little pen over here. It's a little expense, okay? So every time we write, we use it up, and then we throw it in the garbage, okay? It's good now, right? We don't throw it, right? So this is also an expense. Another expense will be little things like water, okay? We consume some water, whether it's employees or some other things. This is all expense. Now, you can begin to think about the expenses of this university. It's got expenses about administration, about bureaucracy, expenses about security, people who work as security, okay? Expenses about cleaning, expenses about making a new road, maybe fixing the basketball court, okay? Maybe making a new fitness room for exercise, making a gym, right? Expense maybe maintaining a swimming pool for the university, okay? So all of this is the money which the business has to spend, or other resources which it has to spend in order to keep the business going. Okay, so let's mention common sources of revenues. I already mentioned money received for a good or service. We call this sales. We also have fees, okay? You guys pay tuition and fees, okay? So tuition is also a type of revenue. Services, for example, a massage service, okay? That's a type of service. Sometimes it's a product with a service, as in a restaurant. A restaurant will give you a meal, which is food, but it's also a service. Someone comes in and hands the food to you, right? Okay. Sometimes it's pure service, like a movie theater, okay? That's a service. A service is phone, telephone service, okay? Or internet connection, that's all service. Commissions, if you're charging your customers, okay? So commission could be a revenue when you charge the commission and you get the money. But commission can be expense when somebody else is charging you commission and you pay a commission. We still got a lot of people talking, okay? Please, you can talk after class, okay? It's recorded, you can talk later, okay? Interest is money paid for borrowed money. In other words, money paid on a loan, okay? So, interest could be interest revenue and interest expense. If you lend money to somebody else, they give you the money back with interest. Then interest is for you, revenue. On the other hand, for example, you purchase. Well, the two of you will have to separate a little bit, okay? Too much. All right, we'll just keep talking. Okay? Next time. Okay? So, interest can be expensive. You buy a little motorcycle, okay? And the motorcycle can cost, I don't know, 40,000. And you pay 40 months, 1,000 each. Or, let's say, 20 months, 2,000 each. Okay? But they will charge you a little bit more. And they say, oh, but if you want to make 20 payments, it's not going to be 2,000, it's going to be 2,200. And the 200 each month you pay is called interest, okay? So instead of paying a total of 40,000, you're going to pay a total of 44,000. 40,000 which you borrow is called principal. And the 4 extra thousand that you pay is called interest. The interest, if you pay it, is expense. The interest, if you receive it, is revenue, okay? Dividends is a little tricky. But dividend, if you invest in a company, in your own shares, and that company pays you dividend, then it's a dividend revenue, okay? Which is very, very different from the dividend we talk about here when the company pays out to its own. This dividend is when one company owns another company, okay? And the other company pays the dividend to the first company, okay? That's a dividend revenue. Royalty is when a company gives somebody else the permission to use a particular trademark, a particular brand name, okay? And finally, a very common revenue is rent. And rent is money paid to use real estate. Real estate. So you can use a garage and then you pay rent. It's a rent expense. Or if you own an apartment, you give the apartment to somebody else. When they pay you money, you receive revenue, and it's a rent revenue for you. So you can pay rent, and it's a rent expense, or you can receive rent, and it's a rent revenue. It depends on who owns the real estate and who pays the rent. Okay? Expenses, we say, are the costs. This is the cost of assets which are consumed. So we consume now electricity. We consume now this little pen, okay? When you talk on the phone, you consume minutes on the server. So it is the cost of assets consumed or of services used. Example of a services used will be, for example, the university, instead of hiring its own security guards, it's using a security company, and the security company provides security, provides the cameras, provides everything else. An example of a service which this university uses, like every other, is internet service, okay? They take from the telecommunication company a service, which is the internet service, and they pay the internet service, and then they have separately in each room Wi-Fi for you to use. Okay. And here's the key to expense. Expense is used in the process to make revenue. So, you have to generate revenue. It's got to be spent to make money. This is what is well known in America from hundreds of years ago, where they say you got to spend money to make money. Okay? The spending money is called expense. The make money is called revenue. Okay? So you got to spend money to make money. So expenses are about spending money in order to earn revenue. Earn is the same as what we like to use or call generate revenue. Okay? And the common expenses are salaries. Every business has employees. You got to pay a salary. Salary is the money which is paid to employee for a period of time, usually 1 month or 1 week. 1 week or 1 month. Wage is when you pay a person for 1 hour of work, or sometimes daily work. Okay? Very common, I understand, here in Thailand, that you say, oh, you go in here, you sit in the shop, you sell whatever. You sell shirts, okay? And we pay you a wage of 500 baht per day, or 300, or whatever, 200. Okay? So, if it's a daily, you call it daily wage. So it's or hourly wage. They say we pay you 20 baht per hour. You work 10 hours, you get 200. Okay, you work 6 hours, you get 120. Okay, rent expense. I already explained rent revenue, which is the money you receive when you give real estate for rent. This is the money you pay when you use real estate. You also have utilities, and I explained one utility is electricity. Another utility is water. Okay? So water, electricity is expense which business has. Okay? And taxes. Taxes, meaning money paid by the business to the government, is considered or treated as an expense. It's a tax expense. It is essentially expense for having the permission from the government to run your business. Okay? I mean, in order to run it, you got to pay the government. It's an expense. So this is owner's equity. Okay? And this piece here, expenses, explains this one here. Let's see what else we got. The next piece is transaction. And transaction is something. We call it event. Something which happens. Event. It's a business or economic. In other words, something where something of value happens. Something of value. So it's a business's economic event which is recorded. Okay? So if it's a transaction, it must be recorded. In other words, there's going to be something happening. I will give you, we will be covering in the next hour a number of different examples of transactions and how we record these transactions. Okay? So, the transaction may be external. Okay? An external transaction is customer comes, orders a lunch for 50 baht. Okay? Now, transaction goes two ways. You deliver the lunch, he pays you 50. Okay? So, that's an example of a service. Okay? But it could be internal. Internal is at the end of the month comes and you got to pay salary to the employee. That's internal transaction. very important to understand. Not all activities are transactions. Not all activities are transactions. We still have a lot of people talking over there. Those two. Can you tell those two over there that you're too busy? All right? Just keep talking everywhere. So, yeah. We got a lot of people still just talking to each other, okay? We're going to talk later, not now, okay? You can talk all evening, all night, okay? So, not all activities represent transactions. So, something can happen which is not necessarily a transaction. And therefore, there is no recording. It happens, but you don't record it, okay? And I will give you on the quiz one or two of these. Something I tell you happened, but not really. For example, simple example. Rain coming out. Not a real transaction. Does not affect the business, okay? There's nothing real important that happened just because it's raining outside, okay? So, another example which I gave you last time is, I'll repeat again, you hire a new employee. When you hire him, there is no real transaction. There is a transaction when you hire him and give him a sign-up bonus because he comes to work today and you give him $1,000 for beginning to work, okay? That's a transaction because you actually give him cash, okay? But usually when you hire somebody, there is no real transaction until the end of the month when you actually pay cash for his salary, okay? So, not everything. So, activity doesn't mean transaction. Activity is something happens. Transaction is something happens and you must record, okay? So, you need to differentiate between activity and transaction, okay? And I'll be explaining a lot more and actually will be giving an example. Every transaction has dual. Dual means two, has double effect or has two effects on the accounting equation. And I'll be providing more examples, but I'll just give you, for example, it may reduce one asset, increase another asset. This means you convert one asset to another asset. Example, you spend 10,000 baht and you buy a computer, okay? You convert cash to laptop, okay? It's a simple transaction of converting one asset to another. So, any type of purchase, you purchase share. You reduce cash, meaning you pay cash, cash goes down, share goes up, okay? So, that's an example. One asset goes down, another asset goes up. And you got all sorts of possibilities. I'll be explaining this in a minute or in the next hour. So, this is a basic question, which we'll try to, or at least I'll explain here, is which of the following events are recorded? So, which of these events is a transaction and which is not a transaction? Number one, supplies are purchased on account. Supply purchased on account. Let's explain this word on account. On account means that you have a regular relationship with the seller. We call it supplier. You are a regular customer to the supplier. And the supplier, when he supplies you, you don't pay cash. He just puts it on the account. Okay? Means on the account means it will get paid later, at the end of the week, or later, at the end of the month. So on account means deliver it now, pay later. Okay? That's what on account. So supplies are purchased on account. Example, university will buy one thousands of these pilot whiteboard markers, okay? So when the bookstore, or we call them supplier, delivers them, university is not going to pay in 1 minute, right? That's not going to happen. Meaning, they're good people, it's a very good business, it will pay, but they say, you put it on our account, at the end of the month, we will pay you. Because we're going to buy also this, we're going to buy highlighters, we're going to buy 10 or 20. So, if the university makes 5 or 10 or 15 purchases during the month, they're not going to make 15 payments, okay? They will add all the money spent, and at the end of the month, they will pay that account, okay? You understand? That's very simple, right? I mean, they're not going to make 15 or 20. In other words, every time there is a delivery, there is no immediate payment. They put it on account, and at the end of the month, or maybe at the end of the week, okay? Or the university may say, or we will pay you every 3 months when we get tuition money, okay? So when the university gets tuition, it pays to the supplier. So is this a transaction? Yes or no? Well, raise hands. How many think it's a transaction? We got to be recording. Nobody? How many thinks it's not a transaction? 1, 2, oh, we have 3 hands. All the others? The answer is yes, it is a transaction. It has to be recorded. Next example, an employee is hired. In this particular case, it is not a transaction, okay? Nothing really. There is no bonus payment. Nothing really is happening. There will be a transaction at the end of the month when they actually pay 7. I think they already have this. Yeah. You see, supplies are purchased. It's a transaction. You must record. Then for the employee is hired. You don't record. Now let's see. Owner withdraws cash for personal use. The withdrawal of cash for personal use we call dividend. So, owner gets paid cash. Is this a transaction? Yes, okay. So we got people finally waking up, right? Yes, it is a transaction because money goes out of the business. Yes. Next slide. Another discussion question. Let's see what's the discussion. Paula invested additional 10,000 King's Pharmacy, which is organized. King's account were recorded this receipt as an increase in cash and revenue. Let's try this. So, the owner, meaning the investor, invests 10,000 in the business and cash goes up, okay? And it is recorded as a revenue. So, is this treatment appropriate? And the answer is, investment is not a revenue. It is not appropriate treatment. Because investment is not part of the main line of business. It is a transaction between the owner and the business. So, when dividend is paid, it is not really an expense, okay? It's not part of the main operation of the business, okay? And an investment is not part. So, when you have these transactions, let me go back a few screens over here, okay? So, revenue is separate from investment, okay? It increases the equity, but it's separate. So, when you have a revenue, you don't count as investment. When you have investment, it doesn't count as a revenue. Same thing, dividend does not count as expense, okay? An expense does not count as dividend, okay? So, dividend is different from expense, okay? An investment is different from revenue. Important to understand. time to take a little break. Let's see what else we have. Aha! Transaction problem, we take a break here, and in the next hour, we complete the full problem. Okay, 10-minute break.